The biggest question every investor should ask today is not whether silver can reach $80 or even $100. The real question is this: what happens if the entire global financial system enters another period of massive currency debasement? What if the next move in precious metals is much bigger than anyone on Wall Street is prepared for? Today, we're going to break down why respected market veterans are once again making extraordinary predictions for both gold and silver, why Japan could become the trigger that shakes global markets, and why investors around the world are quietly positioning themselves before the next major move begins. Make sure you stay until the end, because one overlooked development could completely change the outlook for precious metals over the coming years. Welcome back to Macro Bullion. I am Alex James, your independent gold, silver, and macroeconomic analyst. Here we focus on facts, data, macro trends, and independent analysis instead of headlines designed to create fear or excitement. Remember, nothing in today's analysis is financial advice. Always do your own research before making any investment decision. Let's begin with one of the boldest forecasts circulating in the precious metals community. A veteran Wall Street analyst with decades of market experience recently argued that silver could eventually reach $1,000 per ounce, while gold could climb toward $20,000 over the longer term. In the nearer term, he also suggested gold could move toward $7,000 and silver toward $200 during the current market cycle. These are forecasts expressed by the commentator featured in the source material, not verified future outcomes, and should be viewed as opinions rather than guarantees. Now, whether you personally agree with those numbers is not the most important point. Markets do not move simply because someone makes a prediction. What matters is understanding the economic reasoning behind those projections. If we ignore the logic and only focus on the headline numbers, we miss the bigger picture that serious investors are watching. One of the biggest concerns discussed is Japan. Many investors underestimate just how interconnected the Japanese and American financial systems have become. Japan remains one of the largest holders of U.S. government debt, and stress in its bond or currency markets can quickly spill into global financial markets. The source highlights Japan as a major area of concern that could influence the coming months and quarters. At the same time, geopolitical uncertainty continues to dominate global headlines. The source references developments involving Iran, the Strait of Hormuz, and the ongoing Russia-Ukraine conflict as examples of events that can increase uncertainty in financial markets. Historically, periods of heightened geopolitical risk have often supported investor demand for traditional safe haven assets such as gold, although market reactions are never guaranteed and depend on many factors. This combination of financial instability and geopolitical uncertainty is exactly why precious metals continue attracting attention. Gold is not simply another commodity. For thousands of years, it has served as a monetary asset during periods of currency instability. Silver shares many of those monetary characteristics while also benefiting from industrial demand, making its price movements potentially more volatile. Another important idea raised in the source is the long history of fiat currencies. Throughout history, governments have repeatedly expanded money supplies during periods of economic stress. Supporters of precious metals argue that such expansion can reduce purchasing power over time, increasing the appeal of hard assets like gold and silver. The source frames this historical pattern as a reason for its long-term bullish outlook on precious metals. As independent analysts, however, we must separate possibility from certainty. No analyst, regardless of experience, can guarantee where prices will trade next month or next year. Precious metals remain volatile assets influenced by inflation, interest rates, central bank policy, investor sentiment, industrial demand, geopolitical developments, and overall economic growth. Extraordinary forecasts should therefore be viewed as scenarios to analyze, not promises of future performance. What we can say with confidence is that the macroeconomic environment is becoming increasingly complex. Government debt levels remain elevated, global tensions continue to evolve, and investors worldwide are paying closer attention to hard assets than they have in years. Whether this becomes the beginning of another historic bull market or simply another volatile cycle remains to be seen. And this is only the beginning. We'll examine why major mining companies are choosing to hold physical metals on their balance sheets, why physical gold continues moving from west to east, and what that could reveal about where sophisticated money believes the precious metals market is heading. Now let's move beyond the precious metals market itself and look at the financial system that ultimately determines where gold and silver could go over the next several years. Because if you truly want to understand why investors are paying so much attention to bullion today, you have to stop looking only at gold charts and start looking at the bond market, government debt, and the world's major currencies. This is where the real story begins. One of the biggest developments discussed in the source material is the growing stress surrounding Japan's financial system. Many investors think Japan's problems are isolated, but that simply isn't true. Japan remains one of the largest economies in the world and one of the biggest holders of U.S. government debt. Its banking system, bond market, and currency are deeply connected to global financial markets. According to the source, recent events involving the Japanese yen have attracted significant attention, including reports of large-scale efforts to stabilize the currency. Now, whether every claim circulating on social media is accurate is another matter entirely. As independent analysts, we must separate verified information from speculation. The source references a widely shared image involving U.S. Treasury Secretary Scott Bessent and discusses reported plans to purchase Japanese yen. While such reports generated considerable discussion online, investors should always rely on official government statements before drawing conclusions from unofficial photographs or internet speculation. What matters more than the photograph itself is the broader concern it reflects, the growing instability surrounding major fiat currencies. Let's think about the bigger picture. For decades, governments have relied on debt to finance spending. Borrowing itself is not unusual. The problem begins when debt grows faster than the economy that must eventually support it. That is exactly the concern being raised in the source material. The United States now carries an enormous national debt. Every year, a portion of that debt matures and must be refinanced. If interest rates remain elevated, governments are forced to refinance older, lower-cost debt at significantly higher borrowing costs. According to the source, rising Treasury yields increase annual interest expenses and create concern about a potential debt spiral if borrowing costs remain high for an extended period. This is why bond yields matter so much. Many retail investors focus only on stock prices or cryptocurrency, but professional investors often begin their analysis with the bond market because bonds influence nearly every asset class. Higher bond yields increase borrowing costs for governments, businesses, and consumers. Mortgage rates rise. Corporate financing becomes more expensive. Economic growth can slow. At the same time, governments face increasing pressure as interest payments consume a larger share of public finances. The source points out that long-term Treasury yields have climbed toward levels not seen for many years, raising concerns about future refinancing costs. Again, these figures reflect the discussion presented in the source and illustrate why bond markets have become a central focus for macro investors. Now connect this to precious metals. Historically, periods of financial stress often increase interest in assets viewed as stores of value. Gold does not carry default risk in the same way government debt does. It cannot be printed by a central bank, and its global supply grows relatively slowly compared with paper currency. That is one reason many institutional investors include gold as part of a diversified portfolio. Silver shares some of those characteristics, but it also has another advantage. Unlike gold, silver is heavily used in industry. Solar panels, electronics, electric vehicles, medical technology, and advanced manufacturing all require significant amounts of silver. This means silver's price can be influenced by both investment demand and industrial consumption, making it one of the most dynamic metals in the commodity market. Another important point raised in the source concerns the global bond market. The author describes surging bond yields as a warning sign for the broader financial system, arguing that debt markets are becoming increasingly fragile. Whether or not that view proves correct, it highlights an issue that deserves attention. When debt grows faster than economic output for many years, governments eventually face difficult policy choices. Those choices generally fall into several categories: raise taxes, reduce spending, allow higher inflation, or increase borrowing even further. None of those options is politically easy. That is exactly why macro investors continue watching central banks, fiscal policy, and precious metals together rather than in isolation. Because history has repeatedly shown that major shifts in monetary policy rarely occur without creating significant moves across financial markets. We'll examine why the US dollar is sitting at one of its most important technical levels in decades, why central banks and institutions continue accumulating physical gold, and why some analysts believe the world's monetary system could be entering another historic transition. As we continue connecting the dots, one pattern becomes increasingly difficult to ignore. It's not just individual investors buying precious metals anymore. We're seeing governments, financial institutions, corporations, and even some of the largest players in digital finance quietly increasing their exposure to physical gold. Whether they all share the same motivation is impossible to know, but when different sectors begin moving in a similar direction, serious investors pay attention. Let's begin with the US dollar. For decades, the US dollar index, commonly known as the DXY, has been one of the most closely watched indicators in global finance. It measures the dollar's strength against a basket of major foreign currencies. According to the source material, the dollar recently weakened below an important technical level after multiple failed attempts to remain above it. The source argues that this could represent an important long-term technical development for financial markets. Now, why should gold and silver investors care about the dollar? Because historically, there has often been an inverse relationship between the US dollar and precious metals. When the dollar strengthens significantly, gold and silver sometimes face pressure because commodities become more expensive for international buyers. On the other hand, when confidence in the dollar weakens or the currency loses purchasing power, investors frequently seek alternative stores of value, including precious metals. The source even points to the period between 2001 and 2011, when the dollar index declined substantially while silver experienced one of the strongest bull markets in modern history. That historical comparison does not guarantee history will repeat itself, but it illustrates why experienced macro investors continue monitoring currency trends alongside precious metals. But currencies are only one piece of the puzzle. The source also discusses continued efforts by authorities to stabilize the Japanese yen following periods of significant market volatility. Whether those interventions ultimately succeed remains uncertain, but the broader message is clear. Governments around the world are increasingly forced to defend their currencies as debt levels rise and financial conditions become more fragile. Now let's turn our attention to one of the most fascinating developments mentioned in the source: Tether. Most people know Tether as the company behind the world's largest US dollar-backed stablecoin. However, according to the source, the company also continues expanding its physical gold holdings. During the second quarter, Tether reportedly added another 14 tons of physical gold, bringing its total holdings to more than 146 tons, valued at approximately $18.8 billion. The company also reported approximately $1.5 billion in operating profit during the same period. Think about what this means. A company operating in one of the newest areas of modern finance, digital assets, is simultaneously increasing its ownership of one of humanity's oldest monetary assets. That alone should make investors stop and think. Technology continues to evolve at an incredible pace, yet many of the largest financial institutions still view physical gold as an important reserve asset. This isn't happening only among private companies. For several years, central banks around the world have also continued adding gold to their reserves. Their reasons may differ from country to country. Some may seek diversification, others may want to reduce dependence on foreign currencies. Some simply view gold as a long-term reserve asset that carries no counterparty risk. Whatever the motivation, the trend itself is difficult to ignore. At the same time, physical demand from China, India, and other emerging economies remains significant, while newly mined supply grows only gradually. Mining projects often require years of exploration, environmental approvals, financing, and construction before production begins. That means if investment demand accelerates sharply, supply cannot instantly respond. This supply-demand relationship is one reason silver often experiences greater volatility than gold. Silver has a much smaller market than gold. Even relatively modest increases in investment demand can create outsized price movements because the available above-ground inventory is far more limited. However, investors should also recognize the risks. Precious metals rarely move in straight lines. Even during powerful bull markets, corrections of 20%, 30%, or even 40% have occurred throughout history. Emotional investing often leads people to buy near temporary highs and sell during periods of fear. Successful long-term investors understand that patience matters just as much as conviction. As independent analysts, our job is not to predict every daily price movement. Our job is to understand the forces shaping the macroeconomic landscape and prepare for multiple possible outcomes, because markets reward preparation, not emotion. We'll bring everything together. We'll examine the biggest risks ahead, discuss realistic scenarios for gold and silver over the coming years, and answer the question every investor wants to know. Is this simply another market cycle, or are we witnessing the early stages of a much larger monetary shift? As we reach the end of today's analysis, let's step back and connect every piece of the puzzle. Throughout this discussion, we've examined bold forecasts for gold and silver, growing geopolitical uncertainty, rising government debt, pressure in the bond market, weakness in major fiat currencies, physical gold flowing from west to east, mining companies retaining more of their production, and institutions increasing their exposure to physical bullion. None of these developments by themselves guarantee that gold will reach $7,000 or silver will climb to $200 this year, but together they paint a picture of a financial system that is under increasing pressure and facing challenges unlike anything we've seen in decades. One of the biggest lessons from history is that financial crises rarely begin where the public is looking. Most investors spend their time watching stock prices, cryptocurrency charts, or the latest headlines. Meanwhile, professional macro investors are paying close attention to government debt, bond yields, currency markets, and central bank actions. Those are often the first places where deeper structural problems begin to appear. The source repeatedly emphasizes that today's monetary system is built on fiat currencies and argues that long-term expansion of debt and money supply creates risks for purchasing power over time. It also points to rising concern over government borrowing costs, pressure on the US dollar, and continued investor interest in physical gold as reasons why precious metals remain attractive in the current environment. These points represent the source's macroeconomic interpretation rather than verified predictions of future prices. Now let's talk about realistic expectations. Many investors hear price targets like $200 silver, $1,000 silver, or $20,000 gold, and they immediately become either overly excited or completely dismissive. As independent analysts, we should avoid both extremes. Markets do not move in straight lines. Even during historic bull markets, corrections can be violent. Gold has experienced declines of more than 20% several times during long-term uptrends. Silver has historically been even more volatile, with corrections exceeding 30% or 40% occurring within broader bull markets. That means successful investing is not just about identifying the right asset, it is also about managing emotions, controlling risk, and maintaining discipline. What matters most is not predicting the exact price. What matters is understanding the direction of the macroeconomic forces. Today, we continue to see elevated global debt, persistent geopolitical uncertainty, changing central bank policies, and increasing interest in hard assets from both institutions and private investors. These trends explain why precious metals remain an important part of many diversified portfolios. At the same time, investors must remain objective. If inflation falls sharply, economic growth accelerates, interest rates remain high, and confidence in paper currencies strengthens, gold and silver could experience significant periods of consolidation or even decline. That possibility should never be ignored. Likewise, if debt continues expanding faster than economic output, central banks eventually return to easier monetary policies, and confidence in fiat currencies weakens further, precious metals could continue attracting capital from around the world. Both scenarios deserve consideration. That is why successful macro investing is never about blind optimism or blind pessimism. It is about probability, it is about preparation, and above all, it is about protecting purchasing power over the long term. This is exactly why I continue watching the same indicators every week: central bank activity, bond yields, inflation data, employment reports, the US dollar index, physical bullion demand, COMEX positioning, and global geopolitical developments. Those indicators often provide a clearer picture than short-term market noise. So where do I stand today? I believe the long-term fundamentals for precious metals remain constructive, but I also believe investors should expect volatility along the way. There will be rallies that create excitement, and there will be corrections designed to shake out weak hands. That's how every major bull market has behaved throughout history. Remember, extraordinary predictions should always be tested against evidence. Never buy simply because someone on YouTube says silver is going to $1,000. Never sell simply because someone says the bull market is over. Study the data. Understand the macroeconomics. Question every assumption, including mine. Because informed investors make better decisions than emotional investors. If you found today's analysis valuable, make sure you subscribe to Macro Bullion and turn on notifications so you never miss our latest breakdowns on gold, silver, the global economy, central banks, inflation, and macroeconomic trends. Every week, we separate facts from speculation and help you understand what is really happening behind the headlines. I'm Alex James, and thank you for spending your time with me today. Until next time, stay informed, stay prepared, protect your wealth wisely, and as always, do your own research. DYOR.